In a previous video, we talked about sectors as a way to categorize different stock investments. In this video, I want to talk about two other methods, stock styles and the market cap of a company. So let's start with the two different styles, growth and value. With growth style investments, you're focusing less on the current earnings of the company. Instead, you are trying to pick up companies that can grow quickly in the future. So an example of this is a Google, an early stage Google investment. Google was not making a whole lot of money early on, but something about the management team and the product gave it potential to grow its earnings in the future. A lot of growth investors tend to be in the venture capital space. You're making an early stage bet that a company will grow quickly in the future, even though the company does not have current earnings right now, or at least not high current earnings. You're making the bet that over the long run, the company will do very well. Value is kind of the opposite. Instead of focusing on long-term growth, you're focusing more on the current situation, a low price to earnings ratio. You want a company that is a good value right here, right now. The idea behind value investing is to find companies that have good solid fundamentals, but for some reason are out of favor with the market. So you're getting a good bargain. You're kind of bargain hunting with value investing. Some of the big value investors include Warren Buffett. He studied value investing in college under a famous investor called Benjamin Graham, and he's used this technique, buying things on bargains, throughout his entire career. So that's the major difference between growth investing and value investing. They are fundamentally very similar. You are trying to get a good deal at the end of the day, but stylistically, some of the ways that you think and the way that you approach companies could be a little bit different. So it's a good thing to understand the basics of. Let's now move on to market capitalization, which is basically just the size of the company. There are a few broad groups. There are large cap companies, which tend to be greater than $10 billion. And then there are mid-cap companies, which are from $2 to $10 billion. And finally, small-cap companies, which are less than $2 billion. There are also micro-cap companies, which are really, really small. When I say really small, I mean, 100 million or less. But most of the time, those are not publicly traded companies. They tend to be on either private exchanges or penny stocks or some sort of speculative volatile investment. It's actually an entirely different issue. But anyway, I hope this video has helped you understand the basics of growth versus value and also market capitalization. Remember, these are tools to help compare companies. Comparing a small cap company to a large cap company doesn't really make sense. They have different needs. Similarly, comparing a growth company to a value company, you can maybe compare those, but it's not necessarily the best comparison. You want to try to compare apples to apples as much as possible. Thank you very much for watching. For similar videos, I recommend you check out my website, www.canjo.com.